Hi, this is my YouTube video for the Silicon Valley Bank's collapse. We'll cover the introduction, risk drivers, management responses, interesting facts, and a conclusion. Starting with the introduction, SVB was founded in 1983 in Santa Clara, California, specialized in serving tech startups and venture capitalists that traditional banks avoided due to the high risk profile. They quickly built strong relationships with emerging tech companies, offering commercial banking, asset management, and private banking services. As their reputation grew, they expanded their client base from startups to established tech firms and VCs, becoming a trusted partner in the fast-moving tech industry. The bank also leveraged its deep industry knowledge to create tailored solutions, pioneering online banking to support remote financial management. SBB also expanded internationally with offices in US, UK, China, and Israel, managing $209 billion in assets in fiscal year 2023. It became the 16th largest US bank, solidifying its role in the tech ecosystem, and was frequently touted by Forbes as one of America's best banks, reinforcing its role in the tech ecosystem. During the COVID-19 pandemic, the tech industry boomed, and SVB played a key role, banking nearly half of all US venture-backed startups at its peak. As demand for tech solutions surged, SVB's client base expanded rapidly, solidifying its position as the go-to bank for startups and VCs navigating cyclical economic shifts. In 2020, the COVID-19 pandemic disrupted industries, prompting the US government to lower interest rates and fuel investment. By 2021, the low rates sparked the bull market, leading to a surge in SVB's clients and deposits. However, in March 2022, the Federal Reserve began raising rates to curb inflation, creating challenges for SVB as rates quickly increased through 2023. SVB's internal structure fostered a startup-like culture, embracing agility, innovation, and risk, which resonated with its tech-focused clients. This allowed the bank to quickly adapt to industry changes and build strong relationships. By encouraging fast decision-making and product innovation, SVB tailored its services to startups and high-growth sectors, setting it apart from traditional banks. SVB's close ties with VCs also attracted a unique high-risk client base, increasing its deposit volatility. This dependence on VCs tied SVB's success to the tech sector, heightening its exposure to downturns and making it vulnerable to recent economic shifts. Next, I'll discuss the key risk drivers that put stress onto SVB, namely concentration risk, market risk, liquidity risk, and failures in risk management. The dot-com bubble in the late 1990s and early 2000s highlights this concentration risk. Policies like the 1997 Taxpayer Relief Act fueled massive investments in tech startups, inflating valuations. When the bubble burst, many startups failed, and investors lost a collective $5 trillion in market value. SVB's focus on supporting these tech startups tied its stability to the health of this volatile sector. During the dot-com crash, this concentration led to huge losses, with its stock dropping over 50%. While this focus provided strength during growth periods, it also left the bank vulnerable during downturns. SVB's collapse further exposed this risk. When its financial troubles became public, venture capital firms urged portfolio companies to withdraw their funds, leading to a classic bank run, resulting in $42 billion being withdrawn in a single day, driven by a sudden loss of depositors' confidence. Panic spread among SVB's clients, triggering a domino effect of withdrawals. This exposed the bank's vulnerability to rapid shifts in trust, leading to its collapse. So how did this actually happen? SVB bought $80 billion bonds, which seem to offer liquidity. In theory, banks can actually sell these bonds to cover withdrawals and maintain confidence. However, the situation proved to be more complicated. The core issue was interest rate sensitivity. As rates rose, the value of its long-term and low-yield fixed bonds dropped sharply. This devaluation weakened SVB's balance sheets, creating a perception of high risk that spooked investors and depositors. Additionally, SVB faced liquidity pressure, as selling these bonds at a loss limited its ability to meet withdrawal demands. Moreover, most of these bonds were actually classified as held to maturity, creating a mismatch between short-term liabilities and long-term assets. This made it difficult to generate liquidity quickly in a crisis, making the situation worse as depositors' confidence waned. The $42 billion withdrawal that represents 25% of deposits triggered a severe liquidity crisis. To meet these demands, SVB was forced to sell these bonds at a loss, further weakening its financial position. Ultimately, the FDIC intervened to stabilize the situation, underscoring the fragility of SVB's structure during the crisis. Another key factor in SVB's downfall was its inadequate risk management, particularly its reliance on a depositor base of venture-backed startups, making it vulnerable to tech sector downturns. SVB's poor asset allocation without hedging against rising interest rates also exposes its inadequacy. To top it off, the absence of the CRO for 8 months worsened its ability to manage these challenges. Now we'll be taking a look at the responses of SVB's management. Leading up to its collapse, SVB announced a poorly timed capital raise of $1.75 billion to address liquidity concerns and trying to strengthen its balance sheet after a $1.8 billion hole caused by their loss-making bonds. Management hoped that the announcement would restore confidence, but it actually triggered a panic instead, worsening the liquidity crisis. In the days following SVB's capital raise announcement, management even sought regulatory help to address escalating liquidity issues. On the 10th of March, the FDIC took control of SVB, making this one of the largest bank failures in US history. The FDIC's intervention aimed to protect depositors and ensure access to insured funds, providing stability during the crisis. This also helped prevent a cascading bank run, demonstrating a critical role of regulatory oversight in maintaining financial stability during a crisis. Following the collapse, significant leadership changes were also made to restore confidence. Actually, days before the collapse, CEO Gregory Becker and CFO Daniel Beck sold $4.5 million in shares, raising eyebrows about their awareness of the bank's financial instability. By the 19th of April, SVB replaced these two. These changes were vital in addressing the leadership void and restoring stability. Now let's look at some interesting facts about SVB. The bank's role in the venture capital ecosystem was prominent. However, this meant that 90% of deposits were uninsured as business accounts values exceeded the FDIC's 250K insurance threshold, making it vulnerable to mass withdrawals as the fear of being a client is higher. Concerns also rose about SVB's questionable leadership, particularly regarding Joseph Gentil, the CEO of SVB and the former COO of none other than Lehman Brothers. Adding to these worries, both the CEO and CFO sold shares just before the collapse, raising questions about the bank's governance stability. Overall, SVB's story is a cautionary tale that underscores the need to balance rapid growth with prudent risk management. Thank you for your attention.